We went into a bear market, and in some parts of the market, an extreme bear market, the likes of which we have never seen before. AI has captured the imagination of the world, consumers and businesses. Its velocity not continuing to accelerate. Innovation solves problems. It always does.
Hello and welcome to Crypto Street. In this video, we are privileged to have Cathie Wood, the CEO of ARK Invest, who will share her valuable insights on AI investments and the US economy. Today, we will delve into the secrets of the future of Bitcoin. But before we dive in, let's take a look at the latest developments in the cryptocurrency market. On June 2nd, the United States equities markets experienced a significant rally, reflecting positive market sentiment. However, when it comes to Bitcoin and most major altcoins, we are currently witnessing subdued price action, suggesting a lack of buying interest from larger players in the market. Now, without further ado, let's begin our enlightening discussion with Cathie Wood.
We have a debt deal now that President Biden is going to sign. We're not going to have to worry about this until early 2025. They're taking this off the table for election year campaign season, and it makes sense. It's astonishing how fearful the market was of default, though. Credit default swaps on U.S. sovereign debt rose at its peak to 325. Now, this is the price of an insurance policy against default. So it went up to 325, and within the last few days, it's down to 10. So the fear out there was extreme, and the market is enjoying, the stock market, some of a relief rally associated with that fear going away. A year-over-year increase of only 8%, not that 10 to 11% that we need in order to get that 5 to 6% in nominal GDP growth. That is why we think we're going to see a bit of a harder landing here than many people expect. It's velocity not continuing to accelerate. And so what will that mean? It means that something will have to give in nominal GDP, either pricing or units or both. So we would not be surprised to see nominal GDP growth on a year-over-year basis disappoint in the second quarter. And if not the second quarter, then certainly the third quarter. That is how we get our hard landing.
Bitcoin is poised for a new paradigm shift that could unfold in the near future. This expectation is supported by various indicators, including an on-chain metric that tracks holder behavior. In late May, this metric signaled a transition phase away from capitulation and toward euphoria for BTC/USD. Market participants widely acknowledge that Bitcoin's price action has reached a critical stage, requiring a decisive direction to be established. On June 2nd, BTC/USD traded near $27,000, following a 7% decline in May. On the same day, the United States equities markets experienced a sharp rally, despite non-farm payrolls in May surpassing economists' expectations and an uptick in the unemployment rate. However, this rally did not translate into positive momentum for the cryptocurrency markets, which remain range-bound. According to Galaxy Digital CEO Mike Novogratz, the lack of institutional buying has contributed to the subdued enthusiasm in the crypto markets. Looking at historical data, Bitcoin's performance in June does not provide a clear advantage to either the bulls or the bears. Over the years, there have been an equal number of positive and negative monthly closes in June. The question arises, will buyers defend the support levels and initiate a robust recovery for Bitcoin and select altcoins? Now, let's return to our discussion with Cathie Wood.
Now, many of you know we think there's going to be a harder landing out there in the economy than most people expect, and we're beginning to see that the stock market is actually appreciating. Now, doesn't that seem inconsistent? No. For the past 2 years, when it relates to innovation and for all of 22 for the broader market, we went into a bear market. and in some parts of the market, an extreme bear market, the likes of which we have never seen before. Innovation stocks were hurt more in this go-around than they were in the tech and telecom bust, when we weren't ready for prime time in terms of these new technologies. The cloud didn't come about until 2006. AI, the first big breakthrough, deep learning, not until 2012. And then the transformer architecture and artificial intelligence, 2018. The tech and telecom bubble happened because too much capital chased too few opportunities too soon. The technologies weren't ready, and the costs were prohibitive. Well, now the costs are coming down to an extreme degree, and AI is a great example of this, and the technologies are ready. Just in terms of costs, ChatGPT, if that model had been developed in 2015, it would have cost $800 million to develop. It was developed in 2020, and it cost roughly $5 million. Think about that. What a rapid cost decline that was. And if it were to be developed today, it would be less than $500,000. And by the year 2030, that model would cost $30. So AI training costs are dropping at a rate of 70% per year. We've never seen anything like this. This is twice as fast, maybe more than twice as fast as Moore's Law. And we think the explosive growth opportunities will happen very quickly as well. I think NVIDIA going from minus 13% revenue growth in its latest quarter, the April quarter, and guiding to a 63% increase in revenue in the next quarter gives you a sense of how quickly companies and consumers are scrambling to take advantage of this new technology. So the conclusion here is we do think we're going into a hard landing, or let's just say a harder landing than most expect. We do think a lot of that is discounted, but it will be uncomfortable enough for companies who are losing pricing power and experiencing margin pressure. It is going to force them to adopt these new technologies faster than otherwise would be the case. Innovation solves problems. It always does. And we believe companies are going to be looking at a major problem, and that is margin degradation that they will want to protect against.
Bitcoin has been trading within a descending channel pattern, and on May 31st, it closed below the 20-day exponential moving average, EMA, of $27,239. Despite this, the bears are struggling to maintain lower levels, and the bulls will attempt to push the price back above the 20-day EMA. If successful, the BTC/USDT pair could reach the resistance line, where strong defense from bears is expected. A price reversal from the resistance line would indicate a potential extension of the pair's stay inside the channel. It is crucial to monitor the support level at $25,250, as a break below it would indicate bearish control. A breakout and close above the channel would be the first sign of strength on the upside, potentially leading the pair toward $31,000. The bulls have successfully defended against attempts by the bears to pull Ether back into the falling wedge pattern. This indicates the bulls' efforts to convert the resistance line into support. The ETH/USDT pair has rebounded off the 20-day EMA, $1,855, signaling a shift in sentiment from selling on rallies to buying on dips. The next objective for the bulls is to propel the price above $1,927 and retest the strong overhead resistance at $2,000. However, if the price turns down and re-enters the wedge, it would invalidate this positive view and potentially trap aggressive bulls, resulting in a long liquidation. In such a scenario, the pair may decline toward the support line of the wedge. Thank you for watching. We appreciate your support and engagement. We value your insights on the future direction of the world of cryptocurrencies. Please share your thoughts in the comments below. Don't forget to like this video and subscribe to our channel for more engaging content.